When we chat at the end of 2023, do you think Bitcoin will be a higher price than it is now or lower? I know that's unfair. I know it's unfair, but we just want to test you.
It's hard. Yeah, it's hard to make 1 year predictions with something so volatile. My expectation would probably be higher, but I also would say I would also doubt that it'd be all time highs.
No,
So
I
my
agree with that.
expectation would be somewhere between here, yeah, like higher than here, lower than it's been. With
We'll
the
take that.
caveat that I mean, if something severe happens, and you have some sort of crazy liquidity crisis, I mean, it's not out of the realm of possibility. It could be lower.
Right.
But my expectation would be somewhere between here and prior highs.
So where is safe to put money right now then?
That's the challenging thing of an inflationary environment. The answer is not that many places. So one of the best performing this year was ironically cash. So inflationary environment, it's ironic to buy cash. If you look in the U.S. System, if you hold dollars in a bank account, you're getting paid near zero most likely. But if you're holding short duration treasuries or money markets, you're at least getting several percentage points to offset some of that inflation. So cash is kind of like a safe haven to lose value slowly. Another thing that's actually gone up this year is a number of decent dividend paying value stocks, right? That went into the year pretty cheap and that have generally continued doing pretty good cash flows and paying pretty high dividends. A lot of those have actually been some of the best places you could be, right? So you did better than cash, you did better than gold, you did better than most risk assets that went down. And so those have been some of the best places to be. And of course, there's some specific sectors like energy stocks and things like that that at varying points of the year did very well. But a general rule was cheap, profitable companies that pay dividends has generally been the best bet this year. We also have, I mean, housing is coming down for obvious reasons, but it's still up year over year. And so especially in linear markets, if someone bought like a reasonably priced house, early this year with a low fixed rate mortgage before mortgage rates shot up, they're generally still doing pretty good with that trade or, that investment, however they want to view it. So there have been a number of ways to either gain a little bit of value or at least lose value less quickly than other places. But kind of one of the remarkable things of this year is that almost everything got hit. So bonds, one of the worst years ever. Stocks, pretty bad year. Gold, was like flat. At one point it was up, then it was down. Now it's kind of flat for the year.
Bitcoin.
And obviously Bitcoin had a bad year. Growth stocks had a horrible year. A lot of those look like shit coins, basically. Like these unprofitable, super high valuation companies just got killed. And so there's been a couple ways to, if you were like a fully long energy or something like that, you made a lot of money. But outside of being very specific, it was a pretty hard year to make money on. So it's more about damage control. An Asian financial crisis is not my base case, but it is something you have to keep watching because with China, you never really know fully what the data is like, right? They selectively release data under President Xi. They've reduced their transparency, right? So for a number of decades, you had rising transparency, rising, at least somewhat market-oriented economy, and under President Xi, you've kind of reversed a lot of that. And so under that framework, it's hard to know for sure what you're looking at. You pretty much had to disregard things like COVID statistics. You had to disregard certain growth metrics. But there are still some out there, but you have to kind of take them with a grain of salt. So I'm less bearish on China than the average bear, let's say. And we also have to look at how that's going to impact the global economy, because one of the things holding energy down was Chinese lockdowns, that they were consuming less energy than they otherwise would or could have, right? So yeah, if you look at Chinese jet flights way down, construction activity down, and to the extent that either goes back up to 2019 levels or exceeds them, that's something coming back to the market and saying we're going to take an extra 1 million barrels a day, 2 million barrels a day of oil, whatever the numbers end up being, and that can put pressure on a tight energy market globally. I think the longer term thing is the fact that we had multiple decades of globalization. So basically, you had a pool of capital, and then you had a number of pools of labor. Let's say China, former Soviet states, that kind of thing. And the last 3 to 4 decades are basically about tying those two things together, saying, okay, we have capital, you have labor. Let's build factories there. Let's build XYZ there, and then ship it. Let's build infrastructure. And now, in a less trustworthy world, in a more multipolar world, we're seeing kind of either a reversal of that trend, or at least like a slowdown and a stoppage of that trend. And that means that more of the cost pressures get pushed back on their own markets. And so I think we're in kind of a more structurally problematic environment for supply chains, where for decades you could ignore resiliency and focus on efficiency because the world was just always getting more and more unified and safer. And now, when you can't rely on that fact, when you have to assume, what if XYZ happens? What if this country invades that? What if relations between these two countries break down? What happens to my supply chain? You have to bake in more resiliency, and that comes at a cost. And so I think that the longer term story is that we're probably in a more a somewhat more inflationary environment in that regard, but the extreme edges are taken off because there's not that huge burst. Another thing about COVID is that it, in addition to the stimulus and things like that, it also rapidly changed people's behavior in a short period of time, which supply chains are not good at dealing with. So, like for a while, everybody stopped flying, and instead they started buying electronics and remodeling their home, right? And so that kind of activity just rapidly changes what people need. And that puts a lot of pressure on those areas. And then there's kind of been a kickback where they say, okay, now we remodeled our home. We're not going to remodel our home for 5 years. We want to go on a lot of flights now, right? And so you have almost like a pullback, and so you have disinflation in some of those goods that were inflated to begin with, and now you have plenty of activity in flying and hotels and things like that. And so I think that as that normalizes, we kind of come back down, but these longer term trends are probably still here. So I view us as in a disinflationary cycle within what will probably be an inflationary decade. And that's something that I've been estimating for a while. If anything, it actually came a quarter later than I thought. So if you look at my writings before, I thought that the peak in inflation would come in probably like Q2 of this year. And it kind of dragged on to like Q3. I think in large part because of Russia. And so they just kind of added fuel to a fire that was already there and extended it a little bit. But essentially, you have, a lot of that stimulus money is wearing off. A lot of that demand destruction, or at least demand slowdown, takes place. And so now we're in kind of this period where central banks are fighting back, fiscal authorities are trying to fight back, trying to gain control of that inflation. It's working better in some markets than others. And so my overall expectation is that we're in a disinflationary environment. But when we look out at, say, 2024, 2025, I think that's where we risk having another inflationary spike because the energy situation is still not fundamentally resolved. Basically, by releasing U.S. oil, by China being shut down partially for a while, there's been ways to kind of keep oil from skyrocketing. But if you want to have another cycle of growth ahead, let's say, after we get through 2023, if you go into 2024, you want another cycle of growth. Well, we haven't seen a lot of new energy supply come online. And so that's kind of ready to be a problem all over again. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which, again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure, and so that's been a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. And combined with the China's reopening, that's kind of the one variable to keep watching to say, okay, the U.S. is kind of in some ways purposely putting itself into a recession to try to regain control of inflation. But then the question is, as the market, looks at their inverted yield curve and maybe stops, paying more for the dollar, it allows these other indebted entities around the world to potentially stabilize and start doing okay. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth. I think partially right, partially wrong. So, for example, even myself, like if you said, how high do you think the Fed's going to be able to tighten interest rates before they start causing problems? My number was probably around 3%, but they've already been able to get up to 4%. I think part of it was how quickly they did it, because as I mentioned before, a lot of this operates on a lag. So it's almost like there's very little difference. If you go to like 0% to 3%, like in 1 year, or 0% to 5% in 1 year, that almost doesn't make a difference because refinancing activity came to a halt pretty much. And so it's almost like that extra number barely matters in the near term. Where it starts to matter is quarter after quarter as this plays out. That's where I think it starts causing issues. So I think it's a matter of time rather than just height in terms of interest rates. There's also, it's always hard to measure how much kind of excess liquidity is still in the system, right? So people got stimulus checks, they got child care tax credits, PPP loans that turned into grants. So basically millionaires were given another like $500,000, things like that. And that's just money that's kind of like sitting there, and they kind of like drain that out over time. It starts to getting diffused throughout the economy. And so some people had higher savings rates or, higher savings stashes stored away than I think some analysts realized. And so, I think quarter after quarter, it gets harder. The comparisons get harder from prior quarters as some of the conditions, basically as conditions stay very tight. So I think that's probably one way to look at it, that these things take time. And then also the way I was phrasing it was the Fed can tighten, but they can't normalize, which is that a lot of people are like, oh, there's too much debt, the Fed can never raise rates. And it's like, well, of course they can in the short term, right? I mean, if you look at, for example, U.S. debt, the average maturity is something like 5 years. Now it's somewhat front loaded because you have 30-year debt on one hand, and then you have trillions and trillions of dollars in T-bills, which is that all refinances within say a 2-year period. And so if they raise rates to 5% overnight, it doesn't mean that all U.S. debt is now 5% higher. It basically means that starting with those T-bills, some of the existing short-term debt starts getting refinanced at higher rates, and then it turns into the 1-year treasuries and then the 2-year treasuries, and it's basically more of that maturing debt gets refinanced at higher and higher rates. And so there's a very big difference between, say, holding rates at 5% for 5 years versus doing it for 1 year, because more and more of that debt gets refinanced at that higher rate. And so the way I would phrase it is that the Federal Reserve is unlikely to get back to a period of positive real rates and then maintain it for years. But they can get to either positive rates in the near term, or they can get up to higher rates while inflation is still high. So, for example, what's remarkable is that as much as the Fed has tightened, they're still below the official inflation rate year over year.